All right, let's jump right into a mystery that's hiding in plain sight, right at the heart of the stock market. We're about to pull back the curtain on this invisible force that quietly moves trillions of dollars around, and yet most of us have never even heard of it.
So get this, what if I told you that when you buy a tech fund, you're probably not buying Google, or Meta, or even Netflix? I know, that sounds crazy, right? But the official labels the market slaps on these giants are going to surprise you.
So on one side, you've got what we all just know is tech. I mean, come on. But on the other side, well, that's the market's reality. Google, Meta, and Netflix are all officially classified as communication services. So what's going on here? Who's making these calls and why?
Well, it all comes down to the market's secret rulebook. It's this powerful, kind of invisible framework that decides where every single public company belongs. Let's talk about something called the Global Industry Classification Standard, or GICS for short.
The easiest way to think about GICS is like the market's official dictionary. It was put together back in 1999, and it's basically the universal language used by everyone, from huge pension funds to the ETFs you might have in your own account. It's all about making sure everyone is speaking the same language. And this dictionary is incredibly specific. It's built like a pyramid, you know? It starts with 11 broad sectors, like information technology or financials, and it drills all the way down into 163 different sub-industries. The whole point is to give every single company a very precise home.
And this quote really gets to the heart of why this matters so much. As one analyst put it, indices do not just track the market, they define it. See, these aren't just passive labels. They actively dictate what goes into your tech fund. Which brings us to one of the biggest market shakeups in modern history.
Okay, so let's go back in time to 2018 for what you could really only call a big bang. This was the moment a simple rule change kicked off a trillion-dollar migration of some of the most famous stocks in the world.
So before 2018, the tech sector looked, well, exactly like you'd think it would. You had the heavy hitters, Apple, Microsoft, and right there with them, Alphabet and Facebook. Made sense, right? But the people who write the rules decided, nope, this picture isn't right.
In September of that year, the rule makers got rid of the sleepy old telecommunications sector and invented something new: communication services. The thinking was that companies like Google and Meta were making their money more like media companies, through ads and eyeballs, than like pure software companies. And to fill this brand new sector, they basically kidnapped the superstars right out of tech.
And just like that, the tech sector was completely transformed. Poof! With Google and Facebook gone, the weight of Apple and Microsoft became even more massive. I mean, the actual DNA of what tech meant in the market was changed, like overnight.
And here's where they landed. The new communication services sector was born, a giant, instantly anchored by Alphabet and Meta. Plus, they pulled in companies like Netflix and Disney from totally different sectors. Suddenly, the whole map of the market was redrawn.
Now, this wasn't just on paper. It had huge, real-world effects immediately. Any fund that was built to track technology became a forced seller. They had to dump billions of dollars of Google and Meta stock. It wasn't a choice. Their own rules said they had to. And the weirdest part? Over time, these tech stocks actually started to trade more like their new telecom neighbors than their old software buddies.
And don't think this was just a one-and-done deal. GICS is always changing, always evolving, which leads to these ongoing identity crises, where the official rulebook just doesn't seem to line up with what a company actually does.
Just take a look at the Amazon anomaly. Here we have a titan of cloud computing, a leader in AI, a massive media player, and its official GICS classification is consumer discretionary. It's basically classified as a retailer. Just wrap your head around that for a second. The performance of the entire retail sector often swings on the profits from Amazon's cloud computing business. It's wild. And like I said, these sands are always shifting. After that 2018 Big Bang, we had another jolt in 2023 when payment giants like Visa and MasterCard were yanked out of tech and moved into financials. It really makes you wonder, as technology gets even more advanced, where is a pure AI or a robotics company going to fit? Someone's going to have to make that call.
Okay, so why does any of this matter to you? What's the real takeaway for an everyday investor?
It really all comes down to this idea of forced migrations. When GICS changes a label, all these index funds and ETFs are basically handcuffed. They have to follow the new rules. They're forced to sell stocks to get kicked out of their sector and buy the ones that get added. This has nothing to do with whether a company is good or bad. It's 100% mechanical.
And the scale here, it's just mind-boggling. We're talking about billions of dollars in stocks being forcibly bought and sold, often crammed into a single day, right at the close of the market. All that pressure can create what Wall Street calls price dislocations, where a stock's price moves just because of all this behind-the-scenes plumbing, not because of any real news.
So I'll just leave you with this thought. The next time you go to buy a tech fund, or any sector fund for that matter, just remember this invisible architecture working behind the scenes, and ask yourself one simple question. Do you really know what's inside? Thanks for sticking with me on this one.